Clearco has helped some of the world's fastest growing brands, including a ton of brands that we work with, and they help scale their businesses by providing direct access to marketing capital. If you haven't navigated to foundermade.com recently, which I'm assuming most of you have, considering you're here today, but if you haven't, definitely go online, and there's even a link where you can get your company valued and get access to the capital that you need to build. So please do check that out. That being said, I would love to shift the session over to Jade Scipione. Jade is a senior reporter at CNBC. Jade, are you here? Jade, beautiful Jade. Hello, hello. Good morning. You're on mute.
Oh, wait, can you hear me?
Yes, I can hear you. You're here and live. All right. Now that we're all set, I will let you take it from here.
Let's rock and roll. I mean, how to 10x your growth? That's the $1 million question, right, guys? So I'm excited for our panel. So Daniel, I got to start with you because, I mean, for people who don't know what Clearco does, what it is, how it works, can you kind of explain that to us?
Yeah, sure. No, thank you so much. And thanks everyone for tuning in today. I'm really excited to share the stage with all of you. So yeah, my name is Daniel. I'm at Clearco. We are the largest e-commerce investor in the world. We've deployed over $2 billion of capital into 5,000 founders. And we aim to support their growth in a non-dilutive way. So we provide capital for marketing inventory. We don't take equity, board seats, or any sort of control. You simply pay us back as a percentage of revenue. I guess the last piece I'll mention, since there's a lot of founders watching, is most of our companies are founders. We built the company for founders, by founders. I've built e-commerce companies in the past, and I'm excited to hopefully be a bit useful today and share some thoughts.
Yeah. So Kevin, I know you've launched a slew of startups, most notably Glamnetic. Why does Clearco work for you, and what have you seen?
Yeah. Hey, Jade, how you doing? I think for us, right, I think when, you're self-funding a business, it's super important to, find sources of capital that are quick, that are efficient. For us, we were scaling really, really quickly. So, for perspective, in 2019, we did around $1 million in revenue. And then last year we did 50. And so just the inventory financing from that, it's really, really important to have a funding source. And it was pretty easy to work with Clearco, and it was super helpful. And we worked with them for, I think, the last year now.
Yeah. Hey, Simone. So you over at Andy Swim, can you kind of walk us through, life before Clearco and how it's where you are today, and kind of, any data that can show us the growth that you've seen using this model?
Yeah, like Kevin mentioned, the Clearco loan was super easy and accessible. Before we had Clearco, we were just kind of going at a regular pace. In 2018, we did about 2 million in sales, and now we're expected to be 20x that this coming year. We had been taking out Clearco loans. We actually did it twice. We took loans out towards the end of our peak season to allow us to continue testing into marketing channels and to continue to ramp up and to be prepared for the next busy season. Being a very seasonal business, our peak season is the summer, which makes sense for swimsuits. Going into the fall season, we still need to, maintain the business and to pay our bills, pay marketing expenses, and Clearco really allowed us to do that. Yeah, and just a reminder to anybody who's listening, you guys, this is about you guys. You got questions, Slack us. We'll get to them. So Kevin, the big question for me is this revenue sharing model. I mean, what's the pros and cons with that? And
Sure.
And one of the other big questions is, how does it affect, does it affect you down the line? Maybe if you're pre-seed, will that disrupt things when you're looking to raise capital later?
Yeah, sure. I mean, I think for me, and I think for any founder that's early on, it's just brain damage trying to raise money, or whether it's equity financing or it's debt financing, it's literally brain damage because you're trying to run the business, plus you're trying to put a deck together, you're trying to pitch investors. With us, again, we were scaling so quickly on inventory. For me, I was look, it was a really, really easy way to get a quick glance at how much capital we can get at the point of the business that we were at. And, when I backed into the numbers and backed into what was the actualized interest rate on it, it wasn't that much more than if I would have had to do all the brain damage to try to go to a bank, but I couldn't go to a bank because we're too early on, then a bank would want me to personally guarantee it and all these other things. And so it was a pretty beneficial model for us to make it super easy to get capital. I mean, yes, you're probably paying a little bit more than you are at a bank, but at the same time, I couldn't get a bank loan. And also, I think the way to look at it is as you're building, equity as a business, it's below the line, right? So it's not going to affect your EBITDA. It's going, below the line. It's interest. And so whether I'm getting it at a 3% implied rate or an 11% implied rate, like, yes, I would like to obviously long-term get a better rate, but it's saving us from actually going and raising capital and bringing on an equity partner for the time being. And so I think in that sense, it's pretty cheap.
Yeah. Daniel, what are your thoughts? Obviously, when's the right time to go to Clearco? I mean, is there, what do you look for in the people that you loan money to? And that question about being afterwards going to raise money from other capital, like, I mean, is this going to affect you down the line by using Clearco early if you want to raise money down the line?
Yeah, so I'll talk a bit more broadly about the kind of different ways you can think about funding, because in my personal experience, I've done all of it. I've now gone on the other side outside of Clearco, making some personal equity investments. We help a number of our portfolio companies get introduced to either other VCs or other banks as they grow, because really you should think about the type of capital you raise should be matched to the use of the funds. And so, very specifically for us, we're so focused on marketing because once you're at some degree of scale, relatively what your return is going to be. And so you shouldn't have to pay a lot for that kind of capital. However, where venture is very, very useful and what it's built for is before you're generating any sort of revenue, if you're trying to bring something from the ground up, that's a very risky investment. And the cost of equity matches that return. So a typical venture investor, if you look at the top tier funds, they average probably a 3x return on capital, which means for your investment, they're hoping it'll 10x. So when you think about that from a cost perspective, it's like, I should invest this in things that will generate me a 10x return. Then I'm very happy to pay my investor a 10x return for themselves as well. So I think that's very useful in the early stages, or when you start growing the business. Is it launching a new market, hiring an executive team, R&D to develop new SKUs? I think that's where this helps. And the way we try to plug in as part of it is our capital can be as short-term or as long-term as you need. If there's, you simply need a tranche to bridge you from, for example, any kind of seasonal product like Andy Swim. You have to make your inventory buys probably in the winter time to be ready for summer. But once the summer season hits, they're going to be crushing sales and they'll generate a ton of cash. And then we're probably not needed until the next season, which is totally fine. We have other partners that will take capital every month and they just use that to drive ad spend, and that's okay too. But at some point, if you can go raise an institutional round, you can raise a 5, 10, 20, $30 million round and you don't need our capital anymore, that's fine. So our hope is that because it's so flexible, if it ever becomes a hindrance later on, it'll you can end the relationship anytime you want.
Good to know. As Daniel pointed out, Simone, this is your prime time. What do you guys are seeing to maximize? What channels are working for you? What kind of marketing strategies have been working for you amid COVID? What are you seeing?
Yeah, I mean, Andy actually performed really well during COVID. We didn't see a decline in sales at all. We almost doubled year over year last year, and we're hoping to continue to do that this year. So as far as what we're doing this summer, we're looking for an organic push. We've got a lot of partnerships coming up this summer that we're incredibly excited about. A lot of new co-branded collections, and we really think that's going to help the organic side. We spend a ton on paid media, as I'm sure everybody else does. I see Glamnetics ads all the time on Instagram, and we are trying to just really be efficient there. We have a growth agency that's helping to manage that. And we're constantly looking at the numbers and trying to optimize creative and conversion rates on doing different testing. But for this summer, I think the biggest goal is going to be to see traffic come from other channels outside paid search and social, which would just be like direct channels or partnership type channels.
Yeah, Kevin, what about you? Because I agree with Simone. I see your ads all the time.
Yeah, I think right. We run a lot of ads. I think the name of the game though is you have to get really, really good at the entire flywheel. So you have to be strong at like creative content, social, like brand building, community is super important. You have to back it up with a really amazing product. Then you have to really leverage influencers and an influencer community, double down on the acquisition side on ads. Ad platforms are changing all the time. So you literally have to be looking at things every single day. I saw Don from Credo, the CEO, talk about like live chat. Like, I think it's not only like getting qualified traffic to your site, it's like once they get there, helping guide them through, the purchasing funnel and figuring out what the right product is for them. I'm really, really bullish on live commerce right now. I think that like in 2 years, there's going to be a head of live commerce in every company, like there is a head of influencer relations, and like we're doubling down on that. So I wish there was like 1 or 2 or 3 things that you do. We have to do everything in order to like really, continue to scale this and be successful, particularly with the platforms losing data right now with the iOS updates. And I think every brand is trying to navigate that as we speak.
Yeah. So, Daniel, I know Clearco not only helps with capital, but, they use AI. It's, they have a team to help you. Kind of talk us through, the metrics that you help these companies with.
Really, I think Kevin and Simone touched on some of these key pieces. Every business in general, you have to care about your unit economics and your growth. And so, how profitable are you on a per unit sold basis or a lifetime value basis? And then, how fast can you drive revenue? Assuming like you're in the mindset of like, I really want to make this a massive company. And from a capital perspective, it's pretty straightforward that people spend it on either dollars to run their ads or inventory to buy the things that they're advertising. But outside of that, we've been leveraging a lot of our data to help connect our portfolio companies to other partners that can help drive these drive these metrics. So whether it's an agency, or when we talked about video as an example, we have a partner called Pencil that helps you use AI to generate video creative that talks to Facebook and enhances your return on ad spend. So really, we care about driving the growth metrics, because having been a founder myself, that's really all I cared about. That's all my investors cared about, is what is top line growth? Is it profitable? Can you get to the point where your bottom line profitable, which means you have what I always called infinite life. You no longer have a burn rate and a time of when your company's gonna die and you have to raise another round. Once you become profitable, you can operate for as long as you want. And I think that, to me, that's one of the metrics I would care most about as a founder, and hopefully we're helping achieve that.
I think also to add, I think companies don't focus enough on retention too. So I think a lot of companies think about bringing new customers in the door, but those customers are only as good if they stick around, right? And so like, you're paying a lot to acquire them. You have to back that up with a really, really strong retention strategy to make sure that you're continuously, servicing them and hopefully they're a customer long-term.
Yeah, totally agree with that. Oh yeah, with the retention point, we do a lot, as I'm sure all D2C companies do, and we invest a lot in customer service, making sure that the customers that do come in are happy and are ordering again. We see increased retention from the customers that are coming through or making contact with our customer service representatives, and yeah, just making sure that when we are spending on ad spend, we are looking at the total unit economics, and it's not just a new customer, but are we profitable at every point of the customer's life?
Yeah.
And even like as simple as one thing a brand should be doing, if they're like, if they're sort of in the early stages, they should be DMing every single customer that follows them and turn DM into a prospecting sales funnel. And then on the retention side, they can even like take it a step farther and like check in with them after the order. Like there's a lot of ways to like really go above and beyond to it's sort of like guerrilla marketing, but it's like you kind of got to get down and dirty now with e-com to really like over engage with the customer base to stand out.
Yeah.
On that point, I wish I remember the company name that did it, but they had structured their customer success team into almost 2 types of reps or teams, where one was responsible for the inbound of like, I have an issue with this, I have an issue with that. And the other one was equivalent to like a B2B sales outbound function, where they would call after the first order. And a lot of times they uncovered issues that otherwise would just resulted in an unhappy customer that was, not mad enough that they would call you about it, but they wouldn't have bought from you again. Of like, oh, this was almost the right fit, but like it wasn't perfect. And then in that moment, you're like, no worries, I'll ship you a new one. Like, let me know what's up. Or on retention, your point, how do you just call people that have churned? How do you call people? That's what we did in our business. We had a subscription beauty box about a decade ago, and every month you would have a bunch of failed credit cards, and a lot of people that would churn. And so we'd have a function, a team that would go and call and message and try to get one by one by one by one. And we were bootstrapped at the time, so we had to do that because that's the only way we made money. That's the only way we funded the business.
100%.
Yeah. So what channels are you guys seeing? Because we're in the land of TikTok, Instagram, Twitter. Every day there's some kind of new platform. What's your strategy? I mean, Kevin, I'll start with you. What's your strategy? Do you focus in on one, or you go for everything?
Yeah. So, and again, it depends on the stage that you're at as a company. I think for us, we need to be everywhere. So both on Glamedic and then my other brand, insert name here, it's a women's hair brand. We're pretty focused on a pretty similar strategy where we're all on all of the big platforms. We're playing around with TikTok and Snap and some of the smaller ones. The problem with those is you just can't get real scale yet, right? And then I think the other interesting thing that I'm seeing in the space is that the CPMs on all the paid platforms are rising. The cost of influencers are staying the same, right? So what's interesting is like influencers are now, I think, becoming even more important as long as those costs stay static if you're partnering with influencers and they have really qualified traffic because you actually know the audience that's following them a lot of times where we're losing data from the platforms. And then we do a lot of experimental stuff. Like we're probably going to start launching TV later this year. And like, it's an attribution nightmare and trying to attribute where all the conversions are coming from as you start to, move out to other platforms, but you sort of have to start to look at it like a little bit more holistically. And then, then we even do some fun stuff. Like we're doing some outdoor, brand building stuff, but we can't put too many dollars to that just because it is hard to measure. But I do think there is something to be said about, doing like out of home in a strategic way that sort of drives the overall brand value of the business. And what we've been seeing too is we're in 1,000 Ulta doors because of the amount of dollars we're spending on digital. There's a big uplift in the retail sales from the overall awareness perspective. That's coming from the halo effect of what we're spending.
Yeah.
Any thoughts on that?
Yeah, for us, from the channel perspective, heading into the summer, we're trying to be anywhere and everywhere. Everybody is launching swim right now. And like Kevin mentioned, the CPMs are incredibly high. So we're just trying to be competitive in testing out different channels like display. We also see really efficient conversion on triggered emails. So people that are coming to our sites and bouncing, the conversion on that is higher than our average email conversion. It's higher than, if we're just expecting direct traffic. So that's another way. If you're seeing a lot of people that are bouncing, you can try to get them on a triggered email campaign, and hopefully you don't end up losing that because the investment in triggered emails isn't really that high.
Yeah. So Daniel, as a head of marketing, what are some simple marketing tips, maybe for people who are just starting out that you find useful?
I mean, at the very early stage, whether people are fans of it or not, the channels that everyone, I think, really have to start with once you kind of figure out the product market fit and you sense, the product is working, is starting your paid journey on Facebook and Google, only because that's where the most inventory is. That's where all the, that's what's going to unfortunately drive the bulk of your D2C sales. And if you can't get it to work there, then it'll be harder to identify, new channels that have low entry points to test. And so, I mean, this is just coming from our portfolio of companies. We have, 5,000 companies we've backed, and I can't think of one that's not investing into those two channels. I think another thing that is an alternative to what I just said is taking the opposite approach. We've seen more and more brands get started in wholesale. So whether it's an Ulta, whether it's a Nordstrom, depending on your brand, it's I would say it's a skill that not a lot of brand owners and founders have had to develop because D2C is so easy to start. But if you have a product that resonates with a buyer, I interviewed someone last week, is a great company called Susie Good Fats or Love Good Fats. It's a keto friendly bar. We're just talking about keto in the last conversation, which is why I thought about it. And she made her year because she got into Whole Foods. She started a little bit in DTC, but the whole business was built off the backs of she, somehow got her way to the buyer of Whole Foods. The Whole Foods like, this is the best product ever. I'm going to list you in our top store in Toronto, and then it scaled all around the world. And now she's, I think, over 3 years have done $100 million in sales off of the back of wholesale. So that, I guess that's the other tip or thing I would think about is if you're not a performance marketer and that's not your skill set, and you have a product that could go in retail, that's a strategy I wouldn't ignore, and it could yield amazing returns if you do it well.
Yeah. So Kevin, what about mistakes? If you could go back to your younger self when you were starting out, what kind of marketing mistakes did you make, or even overall mistakes launching something that?
So many. I feel like we make mistakes like every day. I think we tell the team though, like it's good to make mistakes and we give everyone a lot of autonomy, but just like hopefully we minimize big mistakes. I think there's two sides that you can make money on, right? You can get more revenue, or you can actually be super efficient with the way you're looking at costs, right? Like things that we weren't thinking about where we, went back and we're like, wait, if we repackage the way we're shipping these and we could get 5 more points of margin by like repackaging. We just weren't being very efficient with the way we were thinking about the other side of the business, I think in the beginning. So there were a lot of mistakes there. So I'd encourage founders to really not just focus on growth. I'd look at like, how do I run things as tight as possible? On the other side, which is like driving costs down, right? So that whether that's with a vendor, which is your SMS provider, or email, like ask for credits. I'd say that's a big one. I'd say, then I think just like building a team and making sure that we're constantly communicating has just been it's key in like a company as you're growing, is just communication. And I think it's an underrated thing. And so I think in the beginning, when you're moving really quickly, you just want to make sure that the team is all moving in lockstep in the same direction. And then I was going to say, to like Daniel's point, just to add on to basic things to do on the marketing side, you need to have the basics down, like email and SMS, and like you can't run Facebook if you don't have that other side down to hook them in. And then going back to like the DM sales, you can get to 20 to 50K in sales a month, literally DMing customers. And that does not cost you any money. It just takes time, or you hire an intern. And so these are like really simple things that can get your business off the ground in the beginning. And I think the other thing is, if you're a founder, the name of the game is getting lots of content. You can go on Insta stories as the founder, put a face to the brand, talk about the brand. And I think people really buy into a founder that's starting a company, and they can sort of, that's another low hanging fruit that, in the beginning, I think is super valuable.
Yeah.
Yeah. To piggyback off of that a little bit, I wouldn't say that if you've gotten to the point that you're at that you've made any mistakes, but one thing I'll say for all of the founders out there is to invest in yourself and really see your brand as being as big as you think it can be. Anybody that's conservative or bearish on the inventory side, you might run into the situation where you can't actually sell anymore. And that's going to be a huge problem for gaining traction and for growth. So just continue to make sure that you actually have the product there to sell to people, which seems super obvious, but when you're growing from 1 million to 50 million, it's going to be tough. And we've had that same issue on the Andy side, and I know it's something that we're continuing to work through, but just investing in yourself, making sure that you have the product there, and that you're forecasting the business to be as big as it can potentially be.
Yeah. So Daniel, you work with a lot of these founders. What are some of the biggest mistakes you see them making?
Yeah, I mean, I'll talk even from my own personal experience of like the first company we had started in e-commerce was 10 years ago. So we didn't have the privilege of performance through Facebook as it is today. We had the benefit of influencers being free at the time, where we sent them, it was a beauty subscription box. So I could send them a box and we'd get, 10, 20, 30,000 views. But where we screwed it up was unit economics. And it's just a recurring thing. And it's just building on what Kevin and Simone are talking about. You're going to think I'm like a complete moron. And the first version of our box, we didn't plan for the fact that we thought brands would give us samples for free, or they would pay to advertise. Completely wrong. We actually had to pay for the inventory. So for the first 6 months after doing that, we were losing $2 every box. So I'm like, well, this is a terrible business, obviously. We eventually fixed the business model to actually have a positive gross margin, but the margin still wasn't really, even if we had performance, our margin wasn't large enough to actually pay what it was required to acquire customers, and that just really topped out our growth, and we just couldn't grow really the business any further. I think it's not sexy to talk about unit economics and profitability when everyone just cares about top line growth, but the larger that margin is, the more competitive you can be on advertising, so you can actually afford to pay more for customers, and obviously the less product you have to sell to cover your fixed costs. And one other strategy I would add to that Kevin was talking about. This is from one of our venture partners, a guy named Jesse Horowitz at Hubble, and who's also a support of Andy Swim as well. At Hubble, they actually went out and raised or traded an equity stake in their company to lower their MOQs and inventory costs, which gives them a permanent advantage over the competition, where no one can underprice them because they're essentially like owned by their supplier, or have an investment from their supplier. And so I think those little things at the start of the business will give you a competitive advantage forever.
I think one other thing to add that's really, really important, whether you're in finance or not in finance as the founder, you have to become an expert at cash flow, because if you're the founder, things can swing on you really, really quickly. And if you don't have a good grasp on cash flow in an early stage business, you can wake up and all of a sudden, when things start scaling, you could have $1 million or $2 million or $3 million swing if you're not prepared for it. So I'd say just you need to be a good generalist, and obviously have really good finance people in place, but you have to be a generalist when it comes to cash flow.
Yeah. Yes. I think, Simone, the big question is, how much do you borrow, when you are starting out? Do you have any thoughts on that?
I mean, it really depends. You want to be able to cover, for people here that are in inventory-based businesses, you want to be able to cover the inventory and make sure that you're able to sell it, or at least start selling it before you have to pay for it, right? So it all depends on your cash model and what your expenses are. We've borrowed different amounts at different times with different kinds of equity components to financing, and we're still always looking for the next option for financing. But yeah, I mean, it really depends on the stage that you're at and how much you're expecting to scale.
Yeah. So Kevin, you're already answering this, but they want to know how you, at the very beginning, how you built an email list.
Yeah, I mean, I think some early ways we did it was we'd do giveaways, and then we'd have like a custom landing page set up where they'd have to go to the landing page and then sign up with their email and text message number, and like partnering with other brands of, you have to partner on giveaways with other brands with a social following that are similar to yours. So if you have 10,000 followers, you can't go partner with a 200,000 follower brand, but that's like a pretty solid way to try to get a little bit of initial growth in the beginning. And then I'm telling you, the DM strategy is highly underrated. It's very manual and it takes a lot of time, but it's definitely worth it. And then you can literally collect email through that. You can also, you're also collecting a pulse on the business. I think like the number one thing I would say is like, I obsess over the customer, and my co-founders obsess over the customer base. And like, you have to be in the weeds to really, understand what they want.
Yeah. Well, we got to wrap up. Simone, any final thoughts? Daniel, any final thoughts before we got to head out?
Yeah, nothing much for me, but I will just say good luck to everybody. Thank you for your time. This was great.